everybody, welcome back to Metals and Momentum. My name's Anthony, and if you're new here, then I write a investment newsletter over on Substack. If you want to join me there, the link's down in the description. There's a free tier and there is a paid tier. The paid tier comes with trade notifications there. So we've been doing pretty well in our portfolio. I think we're about up somewhere around 28 or something like that percent or something around there. So we're doing pretty decent. One of the reasons why I want to make this video though is because I have been seeing the S&P 500 and I'm looking at the chart here and I am thinking to myself, holy smokes, like it looks like if we are not at an all-time high this week, then I would feel comfortable with saying then we're in for a 12-ish% decline. Now, I want to hop over the chart and show you exactly what I'm looking at here. I'm going to get rid of some of these lines just to kind of clean it up here, but I want to start with like a bigger picture and then we'll go into like what I'm seeing actually here today. So let's turn this into a logarithmic chart, and I was seeing other people use similar trend lines like this, and I was like, does this actually make sense or not? So I was putting them on my chart here. Let's actually just get rid of this one for now, and let's get rid of this one for now. Just trying to clean up the chart here. But if you go back on the S&P 500, this is really interesting. Okay, we'll come back to that note here in a sec. But one of the things that I was seeing on the S&P 500 is you essentially have a giant channel that the S&P 500 has been trading in since 2008. And look at how many times you come back and touch the upper side and then come back and touch the underside of this channel here. I think this is really interesting. You even got a couple pierces below. Happened in what is this? This is 2020, so the COVID pandemic here, and then you got the pierce below in 2008, 2009. What I think is also really interesting is this is the period right here where this was the dot-com bubble. So this is like the beginning of 2000, right in August of 2000 into September. And then you start to get this massive decline. And one of the things that I think is so interesting is you come back and actually end the tech bubble in 02 and bottom out right on top of the channel that we're now actually looking at right now. So this is super interesting. And then if you go back even further, this right here, I was like, what date is this? This is 1982. You also come back and touch the upper side and even get a slight pierce and then a bounce back up, and then you just start that bull run all over again, which is crazy to think about. Going back to 82, that is a long trend line, and I was like, holy smokes. So what I think is really interesting is you have all these areas establishing this trend line, and it's like perfect, right? So we talked about the tech bubble here going into 2008. You get that initial rollover, and then you're tapping on the upper side of this trend line, creating a little bit of this would be a bear flag right here on here. So you got that little sideways chop, it's slightly upward, eventually gets a break, again bear flag, and then you get the break again, which is pretty interesting to see that. And then on the very bottom end, you get that touch of the channel all throughout here, right? Like that's really wild to see. So this is how far this trend line actually goes back. Now, let's talk about, this was March 20, like the COVID pandemic here. You get that flush in between here. And then what I'm noticing is when you start to raise interest rates in 2021 to 2023, like that kind of time period, what I noticed here is you have a 27% decline. This is from the top of the channel to the bottom of the channel. That is a 27% decline. And what I was using is like a date range here. And if you place it from the top and then go to the very bottom, you actually have, I think it was about like 200 days or so from the top to the bottom here. And what I think is so interesting right now is so many people like think that, the S&P 500, it just like, it can never go down. Passive flows are like super important. Everybody's just coming in and buying. It's hard for the market to just come down. But then you go back in history and not even like 1980s, like 1900s, like the 1900 kind of era. That whole time, like this is like recent history, right? We're talking 2022. It took 200 days for the S&P 500 to top out and then go to a bottom and then reestablish a new uptrend here. And I think this could actually happen again, because what's really interesting, and we're going to recent time periods, like we're talking like this month, this year type of thing. What I think is really interesting is you got that pierce, like just in 2008, you got that pierce on the downside of that channel. But what's happening right now, and I'm just going to flick this back out of logarithmic view, is what's happening right now is you're getting that pierce of the upside. And one of the things that I would actually feel comfortable in saying, if we don't make an all-time high this week, then we are due for a 12% correction in the stock market. And what's the scary part about a 12% correction is then what that does is it opens up the door to, if it starts to get like a larger than 12%, like I'm talking like a 15% correction, then what that might actually do is send us back down to the bottom of this channel. And oops, I'm in a date range here. Let me switch over to the percentage. So this right here, like if you go to somewhere around the bottom, that's another 27% decline in the markets. And I could see this happening, but over a period of time. So let's say over the next like 200 days, it's just like a repeat of, 2023 to 2021 to 2023. If you got 200 days and we just measure this out here, this would take us by May 2027, we could be bottoming out here. Now, I don't know for sure if, like, it's not my call right now that I'm saying like, we're in for a 26% decline, and I don't think that's actually going to happen. But one of the ways that, that could happen is if you get this 12% decline or 15% decline that I am projecting right now. So I want to take you into the chart, and I want to show you like what I'm actually seeing in the S&P 500 and why I think a 12% correction to the downside is certainly possible. And then at that 12% correction, you're probably going to have a bounce, one, because, you have a pretty key support line right here. You got all these pivot points. So you got the break upward, retest, break upward, retest back down to here. And then you can carry it on into the bull market that we're currently in. This was the sell-off into the beginning of the Iran war. And then you have that V bounce. And it's like right underneath that trend line. Like, did it even actually confirm? Yeah, I guess this. Okay, so it did confirmed through the trend line, but then you get that immediate recovery and spike back up on top of the trend line, and even establishing it as support right here. You got that breakout, and then you came back and retested that support line and then continued on the gap upward, which is really, really interesting. But the thing that makes me say, we are in for a 12% correction if we do not make an all-time high this week. This is what I'm looking at. Okay, this is pretty crazy. Originally, you made this high, so you could put a point of resistance like right at this all-time high. But one of the things that makes me think that there's multiple points of resistance is, one, you put in this high right here, but then you came back and actually made a lower low. And one of the other things that I'm also noticing is this is actually a bull flag right here. So if you got this right here, downward to sideways chop, this is actually a bull flag. And then you're getting that breakout right now. So in theory, you should have already made like all-time highs by now. Sometimes you get that retrace down to here and then move forward. But the timeline here doesn't actually make sense. And one of the things that if you look back in history, midterm elections are generally pretty, sporadic in markets. Like markets like certainty, and they don't like when, things are kind of up in the air, things are unsure, war in Iran, like our food prices about to go spiking through the roof, our interest rates about to rise. I think they're going to attempt at raising interest rates. And if they did, then, you are going to experience the exact same thing that happened from like 2021 to 2023. That market correction, 26% to the downside, that is what caused that market correction. So one of the things that I'm seeing right now is, one, you have this all-time high right up here, but then you make a lower low, and then you retest to the bottom of like that. We could essentially just call it the 50-day moving average. We don't even need to pay too much attention to this green channel anymore. But one of the things that I'm thinking about is, what is the upside on the market right here? And I was measuring this out, and I'm recording this on Tuesday, July 21st. I'll post this like pretty much like tomorrow morning. So we'll see it before the market opens tomorrow. But one of the things that I'm looking at is like the upside here is 0.81%, or you have resistance at an all-time high. That's 1.51%, right? And if you're going into a time period where, you're definitely in an uncertain time, that's for sure. If you're going into that time period, especially a midterm election, you would actually expect the market to actually trade sideways to essentially down. I'm reading an excellent book right now. It's about, I just finished this book. It was about the 1873 stock market crash, and it's oddly similar to what is actually going on today. One, the Republicans were in power, and they were essentially expected to be in power for quite some time. Then the stock market crashed. They introduced an inflation bill, which was actually vetoed by the president, Ulysses Grant. I don't know if I'm pronouncing that right. I'm Canadian, so I don't really know like the old presidents of the United States. So the inflation bill, it was vetoed, and then what you ended up seeing is a big spike in deflation during that time period. Not only was the stock market crashing, it was just killing jobs. You go into a massive recession, and on top of that, the Republicans were in power. You actually had a two-term Republican in power. So Ulysses Grant, if I'm pronouncing that name correctly, he was in power before, and then there was a gap, and then he got back into power for the stock market crash of 1873, which is unbelievable to that's a weird coincidence. That is, it feels like history is repeating a little bit on this one, because we have Trump, in power before, Republican, skips a year, and then gains back the power, and he has just been saying, the right now, everything that you want to pay attention to is in the stock market. The stock market is like the most important thing to look at, and it feels like he's kind of losing control right now. You kind of see it in the charts. Is he able to push down oil? He hasn't been really talking about like a peace deal or ending, there hasn't been like 39 ends to the war in Iran lately. And I'm like, what is going on? Like, why was he saying, like, he was like ultra focused on the stock market before, and now, it's kind of been like a little bit of radio silence. I'm not too sure what's going on here. And what you're seeing on the S&P 500 is very, very light volume. I want to show you this because this is really important to kind of see. Look at the volume here. When you were at like this rounded top on the S&P 500, this was like end of 2025 and early 2026. You get this rounded top, but look at the volume here, right? And what I was saying going into this major correction is you're seeing a slight drop off in volume, and the market actually move a little bit higher. which is the exact same thing that's actually happening right now. You see, and what's crazy about this is if you look at the volume here, so this bar, if you go off to the side here, you could see it's at 949.6 million. And that's like, you have a lot of bars around here, around that price point. But when you look back over here, you had a big spike right here. This is over 2 billion in volume. And let me just get the, oh yeah, and look at, like, a lot of volume came into the market, but then like you have one small little green day and then it turns into a down day a couple days after that. But this volume is essentially creating a little bit of what you would call essentially like a wedge, right? You're essentially creating this downward sloping wedge, and this volume needs to either if you're trading the volume, you would want to see it either spike upward or downward, and then you'd place a trade based off of like whatever direction it's actually going to move, right? And what I'm waiting for is to just see this volume just spike to like the downside, and like it would have to be larger than some of these other candles, like right here. Like we'd probably need like something like this. We would probably want like, yeah, negative 2.66 billion. We would want one of those candles that would definitely tell us that there's a large amount of sellers in the market right now, or this could break to the upside too, and we want to see volume to return to like what I would call like maybe like a little bit of a more normal level. So I'm talking like right here, this is like 800, maybe 900 million to about a billion or so in terms of buying volume on the upside. So you'd kind of need that little bit of extra something to get the market over. And what, like I was saying, you see this drop in volume like all throughout here. To the downside, big spike down right here, but you start to see those sellers come in, and what I'm looking for is which way is that volume chart actually going to break. But this is going to play out like this week, right? And even if you go to like the technical patterns, getting to my 12% decline kind of thing, so your upside here is 1.55%, and your downside, the downside is you break back into this channel, and then that would actually be this would be terrible. Like when a chart breaks out and then doesn't actually hold that breakout, that's very bearish. You could assume that you are going to break. If you slid back into this channel, you are probably going to break this upward sloping trend line, and this is our long-term trend line that we were just looking at, right? Like, let me get rid of the volume here and turn this back to logarithmic. Like that red trend line, it goes all the way back. That's the one that we were just looking at, right? So if you fail to break out and then come back into this bull flag, you could safely assume that you're going to break this upward the upward sloping trend line that I have highlighted in red, and what that would immediately signal to you is you're going back down to at least this support line, which is 6.7% decline from where we are, 6.8% decline from where we are. That would take you to a big round number, 7,000 on the S&P 500. We definitely expect a bounce somewhere around there. So, this is not going to go up not go down in a straight line. You're going to get sideways chop. But what would be really interesting is if you start to break that 7,000 and then retest the underside of this support line and then get to this gap fill. And the gap fill is the key to all of this. This gives you like a clear price target for the S&P 500, because when you get gaps upward like this, and then especially like parabolic runs like what the S&P 500 just essentially did here in 2026, you always come back and refill that gap. So you get that big swing upward, but then eventually you come back to this underside, and it would be, let me put a horizontal ray right here. This would be the full gap fill all the way down here. And let's measure this out. So if we filled that gap, that gives you an 11.92% decline on the S&P 500 just to fill that gap. And that is very, very dangerous right now. Like I said, in order to negate this, I think we would have to seriously make all-time highs. And right now, we don't have the volume. Like there's no volume on the S&P 500. We're in the summer kind of doldrums, right? Like there's not really like people buying. There's not really people selling. It's mostly like retail right now. And you know, if retail panics, which you know they do, once this starts to sell off, then retail is going to panic and we can be at 7,000 really, really quickly. And then on top of that, you add into the fact that this is a midterm year. We know midterm years, if you look back in the history, you know, you see midterm years, they're never like smooth sailing, you know, like the market wants that certainty. Once we get the midterm elections all sorted out and like we figure out what's going to go on, then maybe, you know, you move higher. But that's why I'm thinking maybe you don't get that 27% correction like this year, but maybe it's delayed, you know, to God knows when in the future. But what is in the cards right now is a 12% correction to the downside. And you could see it in the chart here, like that gap fill. Gaps always get filled. At some point in time, you are going to come back and retrace to that gap down on the underside here, and you're going to fill that gap. And right underneath us on this gap fill, this is another reason why I think we're going to actually bounce right around here, is because you have actually a pretty key support line. You have a breakout right here, retest right to the 50-day moving average, and you have that support line right underneath you here. Another bounce, and then you even retest it again. So that's 1, 2, and then 3, you break, but then you immediately essentially reclaim it. So if we ever got down to this point right here, I think this is the time to buy, because I don't necessarily see, I don't think that, you know, of course, like anything could happen by the time you get down there. Like things could totally change. Like you could have like maybe the credit bubble, you know, bursting, private credit, you know, a bunch of people just start defaulting on their on their stuff, and you know, you start to get like little, I was going to swear there. You're going to start to default on all your things, and you know, at that point in time, we'll have to reassess. But that gap fill should be a buy zone. And like I said, if we don't break out to the all-time highs this week, then I'll be emailing out to everybody on my subscriber list, you know, Metals and Momentum on Substack. I'll be emailing everybody out. Start to de-risk the portfolio. You got to take those positions off. This year, we're mostly swing trading the year. I did pick up 3 value stocks. I'll actually leave the links to those articles in the description down below, so you can read those on Substack. I went into pretty serious detail on some of them. I tried to keep it somewhat high level because I know most of the people that follow me, they just want the ticker. But I know other people will appreciate the more detailed kind of approach there. They want to learn. So I tried to provide a little bit of both there. So that is where I'm going to leave it. I think, you know, you got to look at this week, and there's a whole bunch of companies reporting earnings this week. And this is one of the reasons why I think if these companies don't start reporting earnings and like the market actually reacts to the upside, then that essentially, like, it pretty much guarantees that, you know, you're gonna get that 12% correction, and we're gonna know this week. So I'm gonna send this video out to my subscribers if we do not make an all-time high this week, and then you can get notified as to what I'm gonna do with my money on the paid tier of Metals and Momentum. Thanks so much for watching. My name is Anthony, and if you like this video, then hit subscribe, because, you know, I only could try and come on, you know, when there's something major going on, and for the most part, we've been been just trading sideways in the market for a little bit of time here, and I just haven't really felt the need to make a video. We've been making trades, that's for sure, over on Metals and Momentum. Like I said, it's $9 a month, and that's Canadian per year or per month to join Metals and Momentum. If you want to do so, hit the links down below. Thanks so much for watching. My name is Anthony. We'll see you in the next one.